This week we're talking about interest rates. So let's begin by talking about the cost of money. Excuse me. Realized returns, or sometimes we call them yields, are another word for the cost of money, quite simply. And so a yield is the dollar return divided by the beginning value. And so that dollar return is going to be your income from whatever asset we're discussing, plus any capital gains that you've earned. And so again, divided by the beginning value. So capital gains then, if we break that down, is just the ending value minus the beginning value. So what factors affect the cost of money? Production opportunities. If production opportunities are limited, then money gets more scarce. Time preferences for consumption, and we'll talk about that actually a little bit more later. Excuse me. Risk. If the environment is risky, then banks are going to be less likely to want to lend money, so that's going to make everyone more risky, and it's going to make the interest rates higher. And then inflation also drives up interest rates, or the cost of money. So let's just look a little bit at interest rate levels. We've got two markets here side by side, and so in one market we have low risk securities, and in the other market we have high risk securities. So if we have low risk securities, remember we have this risk and return trade-off. So the interest rate, or the yield, on those low risk securities is going to be fairly low. But in the high risk securities, we see that everything has kind of jumped up a little bit because we have a higher risk, and so we have a higher yield, because we said that risk is a factor that drives the cost of money. So other determinants of market interest rates, and this is your one big formula for this week. The rate of return is equal to the risk-free rate plus a number of risk premiums. And so then if we break those risk premiums down, those are the DRP, which is the default risk premium, the possibility that the borrower will not pay you back your principal. Liquidity premium, the possibility that you can't sell this instrument when you want to. And a maturity risk premium, just an extra premium that you require for delayed consumption. And so that gets back to that time preferences factor. Now, we need to talk, though, about the difference between real rates and nominal rates. R star is what we're calling the real risk-free rate, and so that would be the T-bond rate if there were no inflation. Unfortunately, there's always inflation, so we're going to have to factor that back in. So R without the star is any nominal or quoted rate. And then we're going to call RRF the rate on Treasury securities that's risk-free. So that's going to be the combination of that real risk-free rate plus inflation. So the premiums that we add to R star are that inflation premium that we just talked about, and then the ones that were already listed in the equation, the DRP, the LP, and the MRP, default risk, liquidity risk, and maturity risk. So now if we're talking about a short-term treasury, then the only premium we're going to add to R star is the inflation premium. So there we're talking about T-bills. If it's a long-term treasury, because remember these treasuries are backed by the full faith and credit of the U.S. government, we're going to add the inflation premium just as we would for a short-term treasury. But because it's long-term, we're going to add the maturity risk premium because we have that time preference for consumption for which we have to be compensated. Now if we switch over to treasuries, switch away from treasuries to corporate securities, these do have a default risk premium and a liquidity premium because they're not backed by the full faith and credit of the U.S. government, so there is a possibility of default, and they're not necessarily as liquid as treasury securities, and so that's why we have to add those two premiums, DRP and LP, to corporate securities. So if we have a short-term corporate, we're going to take R star and add inflation because we have to add that to all four, and DRP and LP. But if it's a long-term corporate security, we're going to add all of the premiums, inflation, default, maturity risk, and liquidity risk.